right, as we fade into yet another Thursday at noon, for those of you watching live, this is Freightonomics, the show / podcast, depending on how you're watching, listening, is the show that combines that economic information and combines it with the freight market and supply chain information to explain what's happening in the world today. I am head of Freight Market Intelligence, Zach Strickland, here at FreightWaves. With me, Chief Economist Anthony Smith.
That's right. And I am going to be monitoring LinkedIn. So if you're indeed watching at 12 noon on this Thursday afternoon and you're on LinkedIn, you want to jump into the conversation, you can do that. Just leave a comment. You want to have a question for me, Zach, you have a comment on any of the stories, a hot take, you can join in and join the show and the conversation.
Yeah, and I like to look at this show, too, as a way to kind of get what's the most high-level topical stuff. If you are in supply chain economics, you need to know the direction of, where things are going. I like to kick things off. If you're starting your week off, this is the information you need to get going. Right. Those Monday morning meetings can be a little bit of a slog at times, and it's like, well, what's going on around me? You got all your numbers in your company, but what's going on outside of these walls and what my particular vision is? So one way I do that, Anthony, is by giving them a little bit of a 2-minute update with all the market information that I think is interesting, at least for this period of time. It's not comprehensive by any means. For that, you will have to obviously dig a little deeper and get a little bit more exposure to our information and Sonar, but I do like to at least kick you off.
That's right. And we're going to get it started in 3, 2, 1, go.
All right, kicking things off like I told you I would for the foreseeable future. Outbound tender volume index. This is my demand side indicator, dramatically down, but we're starting to cross into a period where year-over-year comps are going to get a little bit easier, a little bit softer. You look at this spaghetti chart here. The yellow line you're looking at is the outbound tender volume index from last year. The green line is that of 2021, arguably no longer applicable outside of just saying, hey, this happened. But as things get year over year, you're talking about these volumes dropping, 15, 20% year over year now versus 30%, which should happen moving forward. In the near term, however, if you're looking at week over week changes, a little bit of a downtick, but still not anything to be overly concerned about, certainly not a market collapsing. We're right in line with where we were pre-pandemic for the time being, if not a little bit above. April, a soft month. Traditionally, this index looks like it's got a little bit of resilience into it as we have already started off the week or the month of April. Easter coming up should have a little bit of a downturn in the next week, however. Let's go to the next one. Looking at OTRI versus NTI, our outbound tender rejection index versus spot rates, these are both continuing to deteriorate. April is supposed to be a soft month, and that is proving to be the case here. We thought we had hit a floor for the outbound tender rejection index of about 3.5%, where it was hovering through the entirety of March until the last week of March. It decided to take another downtick. Spot rates, they're in the green line, still coming down. This is a concern. We thought we had bottomed in the spot market. How low can they get? The further down this index drops, the more below cost carriers are operating. Next, last but not least, the forecast chart here. NTI, there in white, NTI-F in blue, and the historical forecast in green. This chart we're going to talk about a little bit more in detail coming up, but the forecast looks like a bottom in April.
Another 2-minute drill here by Zach Strickland. And Zach, so continuing that thought, looking at where we are with spot rates now, we're hoping, of course, that we're going to see a bottoming soon. Of course, the data is showing that there is still potentially more subtle downward movement to be had here. What are we looking at when we're looking at spot rates and, of course, that expectation for contract rates?
Yeah, if we want to go ahead and pull that chart back up, this is actually part of the Newsonomics section that we were going to go through, because I wrote a chart of the week about this exact chart last week, because I find it to be very useful when you're talking about what are we expecting for the next 28 days. We have a forecast algorithm here at FreightWaves called NTIF. It's a forecast of dry van spot rates, our national truckload index, for 28 days. We keep a historical log available to Sonar subscribers to just show you how accurate have we been. Forecasts are imperfect. This one, however, just historically speaking, if you look at the green line, that's the 28-day historical value. So 28 days out, that's what it was predicting. It's actually extraordinarily accurate outside of the holidays this year, where it really kind of missed the mark in terms of predicting the nominal spot rate. However, after coming back into alignment here, and you can read all the reasons for this, why that diverged and stuff on the Chart of the Week article that I wrote this past week on FreightWaves.com. But it's the takeaway here for the near term is that all of these upstream variables that our data science team and engineers have put together are showing a lot of downward pressure in April. And spot rates really haven't fallen that fast previously. So what this is telling me is that even though, it may not fall to that level, to that extent, there's a lot of upstream reasons to think that capacity's going to be as available as it's ever been in the month of April. And and at the very end, you see there's a little bit of an uptick. So that means these pressures alleviate 28 days out.
And so when we're looking at this, Zach, this kind of goes back to, I think, the theme of the show of how applicable is history. And of course, the one that kind of pops into my head, of course, is going to be 2019 and the freight recession that we had then. We're looking at seemingly conditions that I think are weaker than what we saw during that time frame, especially we're looking at, we look at OTRI below where we were then, capacity disk being that loose. And of course, the other big thing is, I think throughout the pandemic, we were able to really hone in on efficiencies and doing more with, seemingly less. And so now we've got more efficient and volumes have also come down.
Yeah, that's, to your point, how applicable is history? Some of the algorithm that predicts this takes history into account. We call that seasonal pressure.
Yeah.
April is a very seasonally soft month when we compare it to March historically. Doesn't mean that April is always going to be softer than March, however. There are other variables in the environment that can disrupt historical patterns. We have had no more disruptive force in our economic environment than the COVID pandemic era, which we are still arguably exiting. So I think that's the thing to really temper any kind of forecast expectations. That's one of the lessons that I think a lot of supply chain professionals learned, is that applying history forward isn't always the best thing to do.
Right.
When we're coming from a period of real strong stability, economic growth, 2010 to 2015-ish, arguably one of the most stable growth cycles in our recent history, for sure, right?
Yeah.
And people continuously want to say, well, that's just how things are going to go back to. Do you think that that's actually something that we can say when we return to normal, that's what normal is?
I think in order for that to happen, we have to also look at what the macro environment was during that time frame. And we also had very, very low interest rate environment there, that coming out of the Great Recession that really kind of started off in 2009. So we saw a lot of that environment really push a lot of investments that wouldn't have happened in other type of macroeconomic environments. We saw business decisions being made that wouldn't have been made in other type of climates from a macro environment standpoint. So I don't think when we have a return to where we were during that time frame, we're going to have the same conditions. So we can get to something similar, but not without, I think, going through a lot of corrections and potential hardships along the way to get to some semblance of that.
Yeah, so how much of history would you apply forward here? Like, say if you said, hey, things have stabilized from the demand side, which arguably is a near-term thing, what would you what would be some of your takeaways from that stable economic environment, and say, okay, what have I learned then that I can apply to now?
I think a big part is going to be short-term consumer memories. So the consumer is always going to be, quick to react or late to react, and then have, a strong, I think, turning point of like saying, never again. So we think about 08, 09, never again will I be in this kind of position. Never again will I put myself in this kind of, potential, hardship. And then that kind of memory fades on the back burner a year or two later. Mm-hmm. You think about, of course, the pandemic, a lot of people getting, potentially furloughed, laid off, with little to, savings probably to pad them for a long-term period of a year or so. never again will I be in this position. But then, of course, stimulus packages get deployed, and now they are, sailing and moving on just fine. So I think one of the constants is going to be the consumer having a short-term memory, but maybe a rash reaction to things that we can expect to happen moving forward when we do have that semblance of normalization. I think that's going to be a big one, and of course, I think businesses looking to maximize efficiency at the expense of potential long-term growth prospects.
Oh man, that's a big one right there. The businesses, like that short-term versus that long-term growth situation. Like that's arguably been one of the biggest debates in terms of how to manage a business, because the financial sector tends to value that 12-month horizon. 6 to 12-month horizon. What have you done for me lately?
Yeah.
Because maximizing return, that's their cycle. They change their portfolios on that level. Because that's their job.
Yeah.
Their job is to manage things. That's every day they're looking at the market and company valuations and figure out, what do I need to do?
And executive incentives.
Yeah.
So what are the incentives for large corporations' executive teams? If they want to hit those incentives to maximize their take home, they're going to do what they need to do to meet to those goals. And those goals, like we just said, are going to likely be near term, and maybe they're going to have detrimental effects on the company, 5 or 10 years down the line, when some of those executives don't even anticipate being there anymore. They're just like, hey, I'm going to be on the next thing. I'm going to be on the next larger company or the next opportunity. So I'm just here to collect my check for the incentives being put in front of me right now.
Yeah, and arguably that's kind of what we've done with the economy.
Yeah.
This is called overheating.
Yeah.
And this is the result of overheating. So when you are kind of thinking about the near term, the 12 months, you really do need to make a decision on whether or not you're going to, plan for the future, which supply chain operators are getting a chance to do right now. Right. Anybody in supply chain, transportation management lately has been able to take a breather, take a breath of fresh air. But arguably, this is the time, as Warren Buffett would put it, for investment.
Yeah.
This is where you get your values. Like anybody that's in M&A right now, I've had the question, is M&A going to cool off? No, this is when you need to buy. This is when valuations go down. That is arguably the best possible time to invest and buy. Now, interest rates going up don't make that as easy of a decision. You have to have the cash available to do that. But arguably, we are still in a state of transition and things are still shaking out. However, Craig Fuller wrote a piece. Our CEO, I like to talk about it when he does this, because very thoughtful when he does it, and when he sees something and feels it, he feels it.
Right.
So he wrote this article. We talked about it on the roundtable this morning a year ago about the freight market downturn is a year old. So when will it turn around? And he goes on to say late quarter three. That's when I expect it to have bottomed, and now we're going to start to see things shake up. What does that mean, however, Anthony Smith, is it's not that things are going to just all of a sudden be great again. It means that he feels that the market will have stabilized enough, capacity will have eroded out of the market to the point where now you can actually see a little bit of pressure on rates.
Right.
And the market will have, some semblance of it's not going to fall apart anymore. Now, I showed you the chart from my article about the forecast.
Yeah.
Forecast takes into account not just historical variables, but upstream variables, imports, and various other things that are predictive of rates or have been predictive of rates in the past. And those are different components. One's history, one's how related are they?
Right.
It looks like the spot market has a chance, and I think it's a pretty good chance, of bottoming in April. And two factors there. All the upstream demand variables say demand stable. Mm-hmm. And then we have seasonal pressure now. So summer volumes, a little bit of a floor forming there. And then, of course, just the cost component of the carriers is going to keep them from dropping their rates that much further unless they are pure desperation mode.
Yeah, and I think when we're also talking about that, we have to also keep in mind a shift is, a change in direction, a change in the business cycle. It doesn't really account for the magnitude. So you can have something bottoming out And now that we're in potentially a recovery trend, doesn't mean that we're going to see rapid or robust spikings back up. It just means that, hey, the direction has stabilized, and now we're starting to see maybe a trend upward compared to further downward movement.
Yeah, and I tend to agree with Craig here. I think it'll be late Q3 before we see any significant sustained upward pressure. Like, I think, yes, the spot market bottoms in April, but it's still kind of on the ground through the summer. We're going to have our seasonal inflection points around the 4th of July, end of June, end of quarter type stuff, but it won't be sustainable. July is typically pretty soft. August, not the best either, related to June. And then Q3, though, that's when arguably we've had enough time to see a lot of this capacity kind of flush itself out. Balance sheets had a lot of buffer on them. All that cash is starting to erode away. So I think Q3, Q4, even though it may not be like a sharp driving force upward, I think it's definitely going to be more reactive.
Yeah, and I think the other thing that we were talking about throughout the midst of the pandemic was all the capacity entering the market. You know, all these new entries, folks that haven't been through some of the cyclical hardships within the industry. So it'll be difficult if you're a newcomer and your first introduction to the market was when you can just, walk into, money and not have to work that hard for it, and you didn't have to think too much about it, just opportunity all around you. It's a completely different market now than what you were introduced to, maybe a year and a half, 2 years ago.
Yeah, and time will tell, but it looks like for now, things are going to be pretty soft. Supply chain professionals got a few more months for sure. So there is an article that caught my eye. Greg Miller, of course, fantastic coverage of the maritime sector here. This is yes, it's a maritime article, but I wanted to talk about it in the context of the economy and why things are different now. They're just different. You can't apply 100% of history forward, and you're expecting this new normal to form. Well, it won't be new normal, a year from now, and it may not be the 2013 that we thought it would be. So Greg Miller writes this article, Mixed Signals, Container Shipping Downturn Not Following the Script. So talk about in line with our theme. And what he was writing about is basically like container freight shipping is just fallen off a cliff. The volumes are down, the rates have fallen off a cliff. If we show the Freightos, the FBXD here, this chart of rates, this is the rates over the last 5 years. You can see the pandemic, you can pick it out, as demand outpaced supply for container shipping. And now we're all the way back, if not below in some instances, rates being where they were prior to the pandemic. And that's after, you see how high they were, Anthony.
Right.
That's after they were like 10x of what they were. And now we've come all the way back down. That is volatility to a T. And that is not healthy to have that kind of situation. But his article is not necessarily around rates for shipping, but leasing. So the charters of ships, that market's actually doing okay. Like you would think, okay, we don't need any more boats.
Right.
Like you can see the rates there. Capacity is already well above demand. However, the indicators are showing that the big three are still buying ships. So new orders are still up. You've got people kind of in the smaller sector still chartering ships. Could be a little bit of de-risking in their supply chain, or they just grown accustomed to having accessibility to these boats. Also, you have the Russia-Ukraine situation. So basically the big shippers or big shipping companies aren't going into Russia. So now there's an increased demand of, that shadow fleet, that shadow trade going into Russia because of all the sanctions. And it's just doing better than expected.
Yeah, and I think that first point you made goes back to the other point that you made of course, the big three are still buying ships, and the Warren Buffett, story around, this is now the time to invest, and looks like that's exactly what they are doing, because this is going to be the best time to really put some of those orders in.
Yeah, and the big takeaway here, just like what you're saying, is this is not the normal downturn. I want to read a quote here from the article. Usually downturns in cyclical industries, and definitely in shipping, transportation, come unexpectedly. We're all surprised, and companies are stuck with stretched balance sheets. Here, when we look at the container sector, liners are flush with cash. You could arguably say the same exact thing for a lot of these truckload operators. They had cash coming out of this overheated environment, which has given them the ability to invest.
Right.
Knight-Swift bought U.S. Express. They wouldn't have had enough cash probably without COVID to do that.
Right.
So that's the nuance of this environment, is that we're not just coming from people making a 93 OR, making 5-7% margins in transportation. We're coming from them making 20 to 30% software money,
Right.
Operating ratios and profit margins going into an area that's obviously muted, which allows them to invest without as much risk.
Exactly. And I mean, that's going to be, I think, the theme, of course, as we continue to move throughout the remainder of 2023 and going into 2024 is really being able to set yourself up for long-term growth and going into the upcoming years, not just looking for that near-term mentality. I think a lot of the companies that are falling by the wayside, potentially we're looking for near-term growth prospects over the last 3 years and not positioning themselves for the long term.
Yeah, and you have to look at the long term right now. This environment, arguably, the most volatile we've ever been in.
Yeah.
So, and I think there's a question here, Anthony, about how much do we value specialization over adaptability? Most of our economic development has been over specialization over the last several decades. It's like we're going to develop something that makes everything more streamlined and efficient, and we just operate. And, like you just said, we're going to focus on operating costs. Walmart just came out and said, we're going to focus on cutting our costs and getting that operating efficiency down. Well, that also requires a very stable environment to do that. You can't just say that, we're going to make cars that look like, the same thing all the time. And the consumers out there with options of saying, I can actually go get something that's not a car that transports me faster and more efficiently. That's the trade-off, is like, how much do you want to invest in something that's always been?
Right.
You really need to, I think the new opportunities here are in change. Like, if you look at the environment we've had, if we just go and say, okay, let's expect everything from the past to move forward, and we're going to try to go back to that way of operating. I think that's fallacy.
Yeah. Yeah, and I think the point around being able to be adaptable is huge, and being able to be nimble, because when you specialize, which is great, being efficient is amazing, but it also makes you vulnerable to potential, interruptions or any kind of disruption for hey, this is now a factor. Now all that specialization that was put in there that was not leaned into adaptability at all is now completely useless. It's like, all right, we're now no longer able to pivot. So putting funds into and investing into specialization has its values, but also being able to pivot, I think, is even more valuable than that.
Yeah, look at what happened to SVB. They were very specialized in the tech sector, no deposit accounts, broke with traditional banking. I certainly don't fault them for that. But at the same time, they were leaning too far in one direction, and it overexposed them to a market that we have today. Finance 101, risk reward. Yeah. You got to hedge your position, especially if you're an entity like a bank.
Exactly.
Like, you just can't be, like, you can have a super high risk sector, but it cannot drive your business model.
Right.
in a fully flushed out industry like that.
Right. And real quick, while we have a few minutes left here, I got to go over some real quick economic numbers.
Let's do it.
So the ISM PMI got released, showing that we are still in contraction from a manufacturing standpoint, now reading at 46.3. This is a downward movement from the previous reported number of, I think it was around 2 percentage points higher. Might be mistaken on that one. I got to double check on that one. But I did see that the new orders component is now down to 44.3 percentage points, down from 47 percentage points not too long ago. And we also have backlogs of orders down to 43.9. So also seeing contraction there. A big story here is, Zach, we got a seasonal adjustment to one of my favorite weekly numbers in the labor market, and that is for initial jobs claims.
Ooh.
So what we saw, of course, throughout the last—
This is the stronghold of the economy.
Stronghold of the economy here, and one that we've been suspicious of for quite some time. The numbers that we've been seeing were under 200,000. After the seasonal adjustment that's been put in, which is massive, we're now seeing that there are 228 initial jobs claims. And this is down from the week before of 242,000. So this is a substantial revision here.
So, I mean, are we going into a recession, Anthony? I mean, this looks like you just gave me the ISM, industrial sector contracting, not a lot of production, not a lot of new orders.
Yeah.
People are unemployed more. Like, where's your figure on the IJC?
So I think, of course, looking at 242 or 228, it's not in that red zone just yet. But when we're seeing job openings start coming down, we're seeing initial jobs claims, trending upwards overall, it definitely doesn't paint a good picture for those consumers that are sitting on some of the lowest savings rates that we haven't seen since 2009, and credit card utilization that continues to go up, and buy now, pay later dependency increasing over the years. So
yeah, I don't want to buy into like the fear mongering component of things, but I mean, there's a lot of cracks.
There's a lot of cracks, and you have to be, I think, more mindful for the potential downsides instead of trying to be hopeful for, hey, this is what we have now. Prepare for the worst case scenario. And that is a pretty bad scenario there that's being painted out.
Adaptability. Yeah. Keep investing in it. I mean, you gotta, not everything's predictable.